Welcome back to Wander and Invest. In this series, we're building a foundation for anyone who wants to start investing and growing their wealth, even if they're starting a little later in life. Today's focus is on building a growth-oriented investment portfolio that works for you, no matter your financial situation. Whether you're able to invest a little each month or have a larger amount to work with, I'll walk you through some essential steps to create a balanced, growth-focused portfolio. A growth-oriented portfolio is simply a collection of investments focused on building wealth over time. Typically, this means prioritizing stocks and other growth assets that have the potential for high returns, balanced with more stable investments to manage risk. The great thing about a growth portfolio is that you can tailor it to your income level and risk tolerance. So whether you're investing $100 a month or $10,000 a year, the basic principles remain the same. Let's look at the core components of a growth-oriented portfolio. Generally, these portfolios are made up of stocks, bonds, and sometimes alternative investments. Here's how each part works to help grow and protect your wealth. Stocks are often the primary growth engine in a portfolio. When you invest in stocks, you're buying ownership in companies, which gives you the potential to benefit as these companies grow. For a growth portfolio, stocks might make up 60 to 80% of your investments. Bonds are more stable than stocks and provide a safety net if the stock market drops. They don't grow as fast as stocks, but they help balance the portfolio's risk. For a growth portfolio, bonds might make up 10 to 30% of your investments. If you're interested, you might also consider a small percentage in alternative investments like real estate or REITs, real estate investment trusts. These can add diversity and sometimes offer returns that aren't tied directly to the stock market. For a growth portfolio, alternative investments might make up 0 to 10% of your investments. Now, let's go over some example portfolios for different income levels. These examples will give you a starting point, whether you're investing a smaller amount or have more funds to work with. Example 1. Low-income investor with $100 to $200 per month. If you're just getting started and can invest $100 to $200 per month, focus on low-cost index funds or ETFs, like the Vanguard Total Stock Market ETF, also known as VTI, or the Vanguard S&P 500 ETF, VOO. These funds provide broad exposure to the stock market and have low fees, which helps keep more of your money invested. With a smaller portfolio, you might go with a simple allocation, 80% in a stock index fund like VOO or VTI, and 20% in a bond fund like BND, the Vanguard Total Bond Market ETF. This balance gives you growth potential while still providing some stability. Example 2. Mid-income investor, investing $500 to $1,000 per month. If you're able to invest between $500 and $1,000 per month, you can diversify a bit more. In addition to VTI or VOO for stocks, consider adding an international stock fund like VXS, the Vanguard Total International Stock ETF, to capture growth opportunities outside the US. An example allocation here might be 70% in stocks, split between VOO or VTI and VXS, 20% in bonds, and 10% in a real estate ETF like VNQ, the Vanguard Real Estate ETF, for added diversification. Example 3. High-income investor, investing over $1,000 per month. For higher-income investors who can invest over $1,000 per month, you have more flexibility to diversify and add assets that can increase your portfolio's resilience to market fluctuations. A sample portfolio might include 60% in stocks, divided among VTI, VXUS, and perhaps a sector-specific fund if you're interested, like technology or healthcare. You could allocate 20% to bonds, 10% to real estate, and maybe 10% to other alternative assets, like commodities or emerging markets. Here are some essential tips for building a successful growth-oriented portfolio, regardless of how much you're investing. First, start with low-cost index funds or ETFs. These funds are cost-effective, diversified, and often outperform most actively managed funds. VTI, VOO, and VXS are excellent starting points. Second, keep fees low. High fees can reduce your returns over time, so aim to keep fees as low as possible, especially if you're just getting started. Third, rebalance annually. Once a year, check your portfolio to make sure your allocations still align with your goals. If stocks have grown significantly, you might sell a bit and add to bonds or other assets to keep your balance. Building a growth-oriented portfolio is one of the best ways to set yourself up for long-term wealth, and it doesn't require a huge income to get started. Start with what you can, keep costs low, and invest consistently. In the next video, we'll cover tax-advantaged accounts like 401ks and IRAs to help you keep more of your money invested and growing. Make sure to subscribe so you don't miss it, and let's keep building wealth together with Wander and Invest.